Uh, now, gentlemen, we move on to our third panel of the day, looking at investment appetite for gas exploration. I'd like to invite my esteemed colleague Adam to the stage, who will then introduce the panelists in turn.
Hi, morning. My name is David Walker. I'm director of Belanga Group. We're upstream oil and gas company producing assets in Kazakhstan, which is gas, in Thailand, which is oil, and then most recently, in the last few years, we went into Myanmar, where we have shallow water block, which is gas, and one onshore block. And I've been director for 5 years. Prior to that, a natural resource investment banker at Citibank and at Deutsche Bank.
Fantastic, Adam.
Adam Janikowski, oil and natural gas banker for CIBC, a Canadian bank. A large part of my focus is actually Asian investment into Canada. But prior to this, I was working for another large investment bank in London, focusing globally.
I'm William Powell. I'm a journalist with Natural Gas World. Before that, I worked at Platts, which launched the Japan-Korea marker for LNG in this part of the world, and I've been covering gas markets since the mid-1990s.
Alan Steen, I'm one of the partners at Havoc Partners, which is a natural resource investment group with interests mostly in oil and gas, but also in helium and precious metals. I'm also the managing director of Kalima Energy, which is developing a gas and condensate play in the Montney Formation in Western Canada.
Fantastic. So quite a broad range of experience and expertise here, and I think we cover pretty much globally a good range across the global gas markets. Really, I wanted to sort of start to paint the picture about the outlook for gas and look at what's gas's evolving role globally. Where do we see the role of gas in the future of the energy mix, and where do we see the sort of upside potential, or indeed if there's any concerns around that? So perhaps we could start over with you, Alan, and work our way back.
I think gas has got itself to a very interesting place in our energy mix, and it has definitely progressed from being the unloved orphan, the thing that you did not want to find with your drill bit, to being very interesting indeed, both in terms of where it sits as a substitution or a transition fuel as we change our energy mix, and how we deliver gas molecules into market, I think is changing and is going to change quite dramatically.
Yeah, it varies immensely across the world. In Europe, gas is very much frowned upon as being a fossil fuel, and it's being talked about as if its days are numbered. In other parts of the world, it is becoming more and more important as coal is being displaced. I think it has a huge future, even in Europe, despite what they say about it, because it is a perfect fuel for counterbalancing the intermittencies you have with renewables. And a lot of governments have lost a lot of money by pretending that you can do without gas. So I think its future is there in Europe as well. But yeah, it's very much an infrastructure-constrained commodity. It's much harder to store than oil. You have to bring it to market quite quickly. It's a lot more expensive, yields fewer returns. So your projects need to be more closely worked out, perhaps, than with an oil field. But a lot of the majors are now talking more about becoming energy companies, and oil is shrinking, and gas is growing as a proportion of the output, for the majors at least.
Adam?
One of the difficulties of going third or fourth on a panel is the easy points are already talked about. I agree with the two panelists, but I would also say I'm very much a gas bull. Starting now, I think now is the time that people need to be thinking about gas's place in the world mix and thinking about where infrastructure should be focused. Without infrastructure, without the ability to move the molecules, gas is probably still the orphan commodity. But it definitely is being it will be a very important part of the energy mix, and we're seeing the large cap and the global majors turn more and more towards gas. Just as a quick example, Shell's acquisition of BG. This will continue. I think we'll see this trend continue to move along, and we'll start to see a lot more focus globally on LNG gasification and the infrastructure around gas.
Excellent.
Yeah, I agree also with my panelists. When we were looking at new territories to go into, the big driver for us in Myanmar was the attraction of gas. There are 4 producing gas fields at the moment, all pretty much which have peaked and heading the slight decline. There's very strong gas pipeline infrastructure to Thailand and to China. There is huge shortage. One of the panelists spoke earlier before about Southeast Asia, fastest growing region on the world. Actually, on the slide he had Vietnam and Indonesia. He didn't have Myanmar, but Myanmar, out of the Southeast Asian countries, from a low base admittedly, is growing about 8.5% GDP annually. But with the biggest constraint is the lack of energy there. If anyone's been there, they've probably seen the frequent power shortages and power cuts which happen on a daily basis. So there is, I'm speaking a bit sort of specifically, but where we're focusing our efforts is just in an area where there is huge demand. Luckily, there is existing infrastructure, which is key in the case of gas, and very strong demand from both the domestic market, Myanmar, but Thailand, China, and other countries surrounding. So from our side, yeah, we're very bullish on gas going forward.
Excellent. So it's a fairly positive view overall going forward, but with some infrastructural challenges, no doubt.
Long-term view. I think that's a very important
how long,
difference.
How long are we thinking? 10 years?
I would say 5 to 7 is when we start to see things turn around, and a lot of that is based upon my observation of where the strip is showing up.
So, and what sort of things do you think need to be addressed within the industry in order to achieve those bullish predictions, or to get to that sweet spot scenario?
If you don't mind me jumping in here,
Sure.
Completely infrastructure. Everything about gas, as we said, is harder to store. You need to have your projects nearby or able to get to the end user quite quickly. Everything needs to be infrastructure. And one of the things that I'm very keenly watching actually is my colleagues in the mining and the battery metal space, and how the battery technology is actually changing, because that has the possibility to both help and harm natural gas as part of the energy mix.
Do you really think that batteries can jump in at the scale required? When you're talking gas infrastructure and making, you know, that energy and that energy storage, I mean, do you really see batteries jumping in at the scale required to make a real impact, other than marginal around the edges, looks fluffy and nice?
I do. One of the names I follow here is actually BYD, the electric vehicle company. I work with them. They're making a big push into Canada, so I've been following their battery technology, and I see the speed at which their battery technology is evolving is incredible. And as the world becomes more energy intensive, the infrastructure to supply that energy to the world is not necessarily there. But if we can deliver some kind of small gas powered energy solution, we'll be able to store it and then provide the upcoming kind of poor middle class, provide them with a bit of an energy solution. I think there's actually a lot of opportunity that we don't think of as kind of large funds, large banks, but we're going to see a significant rise within China, Southeast Asia, Africa. That's really the future, and we need to think about that. How do we deliver gas, energy, on a small scale basis, because we don't have the major infrastructure that we would have, say, in North America, say in Europe. There's a lot of low-hanging, but not, I'd call it low-hanging fruit that people aren't paying attention to right now.
So this is not grid sort of backup, it's more about local consumption.
I'd say both, frankly. I think there is grid backup. I think we're starting to see the peaks. The energy will actually be able to smooth out the peak demand, and I think that's where battery technology will really come over the next 5 to 10 years, and that's where my 5 to 10 year focus my 5 to 7, 5 to 10 year forecast for gas will be coming in. But I see battery technology being played out in all throughout the world, in the grid, off grid. It's going to be it's a new world that we're looking at.
Well, then, do you think batteries are going to be an enabler to allow us to use more gas molecules, or is it actually going to be the threat that makes renewables more reliable?
Pass. That's where I said help or harm. I haven't been able to come up with a cogent answer because I think there's too many unknowns. There's a lot of known unknowns within that thesis. It could be an enabler, but it could also be a serious threat to the industry.
Yeah, that's sort of leading on to my next question is sort of can gas evolve hand in hand with this surge in renewables growth that we're seeing? Or indeed, are renewables going to be taking over a lot of the investment capital? I mean, thinking about it from a sort of investment side perspective of what you know in your respective fields at the moment, do you think the sort of appetite and the sort of headlines that renewables are grabbing, is that pulling dollars away from gas investment at the moment?
I think there's an awful lot of money still pouring into gas. A lot of it is coming from the established players, for whom it's a no-brainer. I mean, you can develop technology and you can develop a field. Like the case in point is Prelude, which is just about to start up. But a Prelude, the FLNG thing, isn't one which anybody can just do because of the huge amounts of capital you need to have at your disposal, plus a market lined up that you can sell the gas into profitably. What's happening in the UK mainly is it's mainly oil that's being bought as these disposals are coming along, and the gas assets are already sort of pre-sold, and they're coming in to manage them more profitably. So it's more about a financial transaction for the investor than it is about producing oil and gas.
Well, if you have a look at, to go back to the Australian example, the political influence on the uptake of renewables is quite strong. And we see a situation in the east coast of Australia where there has been a big push to use more renewables, and that has been a big disincentive to invest in gas. That plus political barriers to investing in gas exploration, because I think the sentiment is that maybe we don't need it, and maybe we can, go to a future that's based on renewables, and there's going to be a logical progression where the answer is your best outcome is a mix. Right?
Cooperation, not competition.
Yeah, and I mean, I think just make the obvious point. It depends market by market. I come from the UK myself. It's clearly at a very developed stage, and wind, solar, hydro, etc. Where I live now in Myanmar, there is just overwhelming demand for energy. I mean, coal is still being used there, not so popular, but it's still very much part of the mix. Oil, obviously. In fairness to the government, making a big push towards renewable. Hydro is already quite a big part of the energy mix. Solar is getting a lot of focus, but just sheer demand, 56 million people, starting from virtually zero infrastructure base. It will end up being some sort of mix, but certainly traditional energy sources are going to be around for a long time in that sort of.
Yeah, Myanmar is able to leapfrog, isn't it?
Exactly.
Mistakes that we made, or perceived mistakes, you can say, well, that didn't work. This might work.
Yeah.
We'll try that, and it may still work.
And just recently, we should all remember that Shell came out and said in their most recent LNG report they anticipate that gas is going to be have a 30% more global demand by 2040, 2050. You can't replace the demand, the energy demand that is increasing by 30% with renewables. It's not impossible. Gas needs to be part of that mix. Again, I'm quite a gas bull. I think market to market, it could be a great investment.
So here's one of the things. When we started this, we all said infrastructure was a big part of it, and that infrastructure is around getting your gas molecule to your end user, whether through a pipeline or LNG. And LNG has challenging timeframes associated with the investment. But reading about just in the last few weeks how pretty much perfected long-distance transmission of the electrons now. And in a couple of years, we could see, long distance transcontinental transmission lines. And that was in the particular case of the Australian example. That changes things quite a bit if it becomes easier to move electrons than it does gas molecules.
Though moving gas molecules is becoming cheaper all the time. There's a cargo on a truck, an ISO truck, left Rotterdam for China, which wouldn't have thought make it any economic sense at all. But last December, prices in China were so high that that's what they did. It doesn't make a lot of sense, but and yet it happens. There are things which are still surprising us economically.
It's still market to market too. We keep coming back to this theme, but it's probably cheaper to build a generation plant in China than it is in the UK. So where does the break-even cost, and how do we look at it? I agree. Maybe some of these large-scale LNG plants might be supplanted by technology being miniaturized, but it's definitely not going away. I haven't looked enough into this electron idea. I think it could be fascinating to figure out how that impacts the economics of energy.
Well, it potentially opens up a whole bunch of new markets for gas.
Exactly.
Well, these are happening around like Bangladesh became one of the new market for gas. They're a big producer, but they began importing LNG now because you can have offshore floating LNG. You can regasify it, ship it into the grid, and then there's no country risk either because it's a floating LNG. You can take it away if the money doesn't arrive. So it's becoming far shorter term, far more competitive, and the big profits of the past are gone now. It's more about where can we act more like utility, take more of a share downstream, and get the rent from the customer himself, rather than selling it to a middleman who will simply pass on the costs to his customer. So it's becoming a lot more. The market's becoming a lot more fragmented, and there's room for more entrants to come into it, investing in different parts of the cycle.
So maybe as a banker, I can just run this out a little further. We've all said that infrastructure is crucially important to the gas market, but where's the better investment? Is it investing into an infrastructure company or an infrastructure project, or is it better investment investing into the underlying commodity?
You definitely want to invest in the upstream end of the whole thing. Not that I'm biased, but
And what are some of the headaches, though, with that investment in the upstream end of things at the moment? Is there are there any challenges with gas at sort of $2.80 price at the moment? Is that appetite for the upstream end of it looking like to pick up with these more bullish projections of the market and a move away from oil?
Should I just make a few comments from our side?
Please.
I've got to say this year feels a lot better than last year, so that's good news. I mean, on the I think speaking as a private E&P company, to survive over the last 3 years or so, you've had to be strongly privately financed. Without that, you're pretty much dead in the water. It's the old, if you have money, it's a lot easier to raise money. From where we are, we're seeing a lot of interest, serious interest this year from Chinese money again, which is coming in quite strongly. I'd say and I defer to my banker colleague, but in terms of, should we say, I think the markets are open again for the right exploration companies if you tick quite a few boxes. I think it was mentioned earlier, in terms of drilling, you've got to be close to that, maybe no more than 6 months or 9 months maximum. Cheap drilling, multi-drilling story, so the risk is diversified. You need third-party validation, so Gaffney Klein report or similar investors. I think that is a must for investors these days. And if you tick enough of those boxes, and good news flow, the right story, and particularly the monetization side, in terms of gas, so in terms of infrastructure, etc. I think the market is selectively back. We'd be interested in your views. But helps also if you have existing strong balance sheets, so that you can go out to the market as required, but you're not 100% dependent on that.
So I have an interesting view on this because we're talking about the market coming back and we're seeing reasonably strong pricing, say in the U.S. But I sit and focus a lot on the Canadian upstream business, and for the call it pure play or heavily weighted gas producers, we're seeing 21. Yesterday, the ACO hub closed at 21 cents. The spot pricing has basically been a dog's breakfast for the last 6 months, maybe even longer. In fact, last summer it was negative. We had to pay people, or producers had to pay people to take gas away from the ACO hub. It's a tale of two markets. Within Canada, I don't think you could get a gas producer to market or raise money. In fact, we haven't seen a strong capital raise in the Canadian market for an E&P company for some time. But within other markets, we're seeing growth, as long as they tick the boxes that you mentioned. One of the themes that I think we'll start seeing within the Canadian E&P space, particularly in gas-weighted companies, is mergers, share-for-share mergers. You've got names like Payne and Pony, Advantage, Birchcliff. They have 30 years P plus P drilling inventory. You can basically buy them for PDP and get 30 years of drilling. What we need to see is capital discipline. So if we start seeing some of these companies start to merge, you can remove some of the executive costs, you can remove some of the G&A, and you can high grade your portfolio. And when that happens, I think we'll start seeing a more robust market within Canada. Within the rest of the world, we are seeing these green shoots, and maybe I'll pass it over to some people who are a little more focused on the rest of the world.
It depends, of course, where you are. There's LNG has become the growth industry by a long way. Because of the attractions of infrastructure and of markets. And technology is improving enormously as well now. You can have almost like plug-and-play power points across power plants in archipelagos like Indonesia, Philippines, places like that. So it's suddenly become a hugely quick business. Rather than being a long, drawn-out process, you can bring things to market relatively quickly. The problems are with financing, because you're no longer able to pass everything on to the customer. You have to find it. Well, financing has become a lot more complicated owing to the change in the contract structure. Everything now is becoming a lot more short term. People don't want to buy LNG for 20 years. They may want to buy it for a couple of months of the year, or maybe 3 years and then something else. They don't know, because they don't know what technology was going to do. You're talking about batteries. No one quite knows where we're going to be in 5 years' time. No one wants to get locked into a 20-year contract and then find out of the money after the first 3 or 4 years. So it's becoming much more complicated to raise financing. And then you have shareholder structure as well. That can make it difficult to raise financing. Like Fortuna LNG, it's been good to go for the last year or so. They haven't been able to take FID because there are too many shareholders involved, too many unaligned interests upstream. Whereas a company like Shell with a Prelude, it's almost all its own, and so financing is far simpler and marketing is far simpler. So it's a question of aligning interests.
Well, I can come at this from two different angles, because in a previous life I was the founder and CEO of Ophir.
Oh, right.
So yeah, we discovered 3 or 4 TCF in Equatorial Guinea, and we are still waiting to see that Fortuna project take FID. As a shareholder, trust me, it is incredibly frustrating. We also discovered 15 T's of gas in Tanzania, and that is still sitting with not one spade of dirt turned on an LNG facility. And we've seen, regrettably, the shares go from a peak of £6 to today 51 pence. So from that perspective, I'm a little bit dark on the upstream landscape for gas. And instead, and despite your quite correct comments about the Canadian sector, even with those ACO prices, because you can get a rich condensate yield, I would far rather be playing the gas game in Western Canada than internationally doing LNG at the moment.
And you think it's symptomatic of gas sector that it's quite a fragmented industry, that's why we've got these huge delays that you mentioned with some of the projects?
I don't think it's a fragmented industry particularly. I think it's a question more about the geographically it's fragmented, but those prices are now converging. People can now have trust in the market price. In the past, that wasn't the case. It was all sort of integrated chains, but now you can see different price signals coming out of Asia, out of Europe, out of the US. So, yeah, markets are becoming, I think, more confident in the ability to hedge their price because of things like exchanges, because of things like the JKM, which gives you a long-term view of, or fairly short, a longish-term view of LNG, which has become dislocated entirely now from crude, gradually at least. So yeah, there's a lot more opportunities for nimbler companies to go in and see opportunities on the trading side. There's a lot of inefficiencies in the system, which companies like Vitol and Trafigura can exploit. So in developed markets, Accelerate, for example, as well. So yeah, I think the old monolithic structure is gone, and we're sort of in between a sort of a fully commoditized, sort of fungible oil world and the old-fashioned, clunky gas model. That's how I see it.
Okay.
Well, the long-term investment on infrastructure is definitely affecting things. So an average build on a large LNG is 4 years. So you can make FID this year, but you're not going to see the impact of the pricing significantly on the upstream and for another 4 years once the construction build is out. So that'll be that changes things a lot. The one thing that I'd like to point out, and I'd really like to hear the panels a bit on, is the politics around carbon pricing, because I think that's another known unknown that is really affecting the pricing of the gas market.
Yeah, I mean, until you have a carbon price of around $30 or $40 a ton, you're not going to see any kind of investment in things like carbon capture and storage, which is a very big part of everyone's assessment of the future. The IEA, all these outlooks for the future assume that CCS is going to be an integral part of the energy world. So far, nobody's doing that except for either political reasons or for EOR, which is only 1 or 2 projects. So you need to have a proper carbon market in Europe, or generally speaking, to incentivize people to do something with the carbon. At the moment, it's a total waste of time. It's a trivial 5 or 6 euros a ton in the European system, I think. And that's because, of course, of the very strong interest of the coal lobby, particularly Germany and Poland, who resisted very successfully any attempts to claw back the number of certificates that may be traded. In other words, the market's been long in rights to emit, and that's why Europe's been importing so much coal from America. And it's all very, very perverse. In Germany, they're spending 25, 30 billion euros a year typically on subsidies for renewables, but the emissions are constant because coal is being burnt as backup fuel. And it doesn't make any kind of economic sense or even any political sense, but it's still happening despite that. And it takes a lot of effort of will to overcome these political, the sort of social desire to not have any kind of coal or nuclear in the system. That's the German thing, was no more nuclear after 2023. That's just,
So it's sort of a political agenda,
Yeah.
votes and
Yes.
winning votes and
Yeah.
seats that's sort of driving an umbrella sort of theme, but really it's undermining development of the sector.
Yeah,
or industry.
also it stifles the market because there's too much unpredictability. You don't know whether a wind farm, what its cost is going to be, what the subsidies are going to be. Britain had the idea of introducing a carbon floor of £18 a ton, which was very good for gas. It really did push up the price. Other countries haven't yet done that, but they're doing other things instead.
If Germany's going non-nuclear, does that mean it's going to stop taking electricity from France?
Well, at the moment, it ought to, but it's like, we're meant to be going no carbon. We're importing coal from the US, and German wind power has decimated Dutch gas-fired businesses. It's all becoming a bit of a mess, and that's partly because there's no overriding European energy policy. Every country can pursue its own goals. Every country wants to have energy security. And that means if you're German, you're building coal. If you're French, you're possibly building nuclear and a bit of gas. But there's a massive overcapacity in generation because every country wants its own, and there's far too much knocking around. And so we're having negative prices, and we're having, the Belgians are unable to decide what to do with their own power plants because their nuclear is going to run out of, reach the end of the lifespan soon. Do they build more? Do they rely on the Dutch? Do they rely on the Germans? Do they rely on Britain? How do they sort of bridge the gap? Is there even a gap? Can they not simply suck it out of the system? There are all kinds of uncertainties because there's no single market for European power or gas. In fact, they're just a series of national goals and then overarching policies which aren't really that enforceable.
This sort of brings to mind something the World Bank announced last year around stopping investing in oil and gas projects from 2019. But they had an important caveat of having an exception for very poor countries that are really in need of this kind of investment. Where do you sort of draw the line between creating policy for tokenistic value or to win votes and actually encouraging energy markets to develop and thrive? I don't know what perhaps your take is on national agendas coming out like that, David.
I'll speak with my Myanmar hat as that's where I'm living these days. I mean, they're classing early stage emerging economy where the biggest drawback to even higher GDP is simply lack of energy. I mean, Toyota turned up with about 20 executives about 12 months ago, and the government offered to give them any piece of land they wanted if they would build a Toyota factory. And after doing all their research, they said, yeah, we'd love to. We'll come back when you can, assure us you've got a decent energy supply. I mean, we just could not put something in. So, they're starting from a low base. I think we mentioned, in saying that, the government's doing a good job to look around the world and look at how renewable energy can come in at a faster pace. But sheer demand, you've got to be able to turn the lights on, etc. And in a lot of parts of Myanmar, there are all sorts of other schemes going on, like mini grid schemes, mini solar projects. All of this is good stuff, but it's really scratching at the edges. So, the fundamentals are still there for major gas, major oil, and definitely for the next 30, 40 years. I don't think that's going to change. Hydro is quite big in Myanmar, but it's it operates well for half of the year because it's simply because of weather conditions. So those are the other factors. And again, with solar in countries like that, when the monsoon comes, clearly affects the impact of the efficiency of the solar side. So we're looking at renewable projects ourselves, but it's difficult to make them work also financially. And the other thing you then have in these sort of markets is, in the case of solar, you need a reasonable amount of land. Land is a very sensitive subject in countries like Myanmar from a farming perspective, ownership perspective. So none of these other projects are easy in themselves as well. So putting that together, it's a big challenge still.
I would say there's a lot of political announcements that feel good and politicians make to win votes, win hearts and minds. But I think when you drill back down to it, at the end of the day, the economic well-being of their constituents is the most important. And I think some of the politicians are caught up in some of the climate change announcements and forgetting it, or never actually learned about how some of these economies work, even in the developed world. Case in point, Canada's currently going towards civil war between BC and Alberta because of one of the oil pipelines. And the federal government is caught in a very tough place, and they could potentially lose their quote-unquote green credentials because they actually have to force through a pipeline for economic well-being of the country. It's very, very interesting to see, not just in developed nations, but in emerging nations, but in developed nations, this tug of war between political interests and economic interests. And what I would probably leave this comment on is Trump got elected on Make America Great Again, which included a big focus on coal. So there is this underlying political backlash against some of the announcements that are being made by groups like the World Bank.
Interesting. But just as an investor, or in terms of the companies and the investors that you might advise, does it really have to be as black and white as sort of renewables and green, and then oil and then gas? We talked about being part of a global energy mix and the balance changing, yes, but from an investor's perspective, the returns are surely potentially much greater from oil and gas than they are from renewables because of the fixed cost nature of renewables. We're sort of simply dealing with sustaining energy systems, but two very different types of investment, really.
Well, looking at the European, and particularly the UK example, nobody really builds any capacity these days unless it's all underpinned by capacity agreements with the government, or authorised by the government, but agreed with National Grid, which does a tendering process, and it buys the cheapest first and so on up the stack. So the idea of when I came in as a reporter 20 years ago, the dash for gas was on everyone's lips. Enron built a 3 gigawatt plant up in Teesside. There were a string of contracts for long-term interruptible contracts around the UK to take advantage of the low gas price. But now no one's doing that speculatively, simply because they don't know what the price of gas is going to be. They don't know what power is going to cost. They don't know what other regulatory interventions are going to be from the European Union or post-Brexit, of course, now. So it's all become, the whole picture's become basically randomized, and it's people aren't willing to risk capital unless they've got it all locked in at a fairly kind of widows and orphans sort of degree of safety. Mm-hmm. So yeah, the market in Europe's been kind of destroyed in favour of long-term political objectives.
Alan, your private equity view?
Just taking the words out of my mouth when it's the rug gets pulled out from under with, you might say, political correctness, which makes for a very difficult investment climate, and that, and you were seeing it. I mean, and BC is a case in point. I mean, and that's about an oil pipeline, but that also has an impact on then BC's desire to see gas pipeline go to the west coast. So life's hard enough, and to go back to the original point, of course it's a balance. It's common sense that you want to see a balance, right? If we could take the politics and the emotion out of it, it would be a lot more straightforward, and it would be possible to plan that and to make investments with confidence. But when you put the emotion and the political correctness in it and the downright lies, it's very difficult to have confidence to make the investments.
Tell it how it is.
Indeed. And that's impacting the retail investor environment as well. We've seen oil been down for quite some time, but in terms of retail investors coming back into this sector and growing the capital in that way, how's that looking for upstream gas companies?
If I could jump in there, one of the really interesting things is we in the investment business, we often talk about risk capital, and oil and natural gas mining are a risk capital business. That's where, if you want a bit more return, you take the risk. What we've been seeing, particularly in the Canadian market, is the risk capital that would traditionally be investing into the oil and gas market, investing into the mining space, has actually been going into marijuana stocks and cryptocurrencies. So we're missing a very fundamental piece of retail investment, retail liquidity, but also fund liquidity that would normally go into oil and natural gas investment. We think that will turn around, but right now you're seeing marijuana stocks trade at 50 times to 200 times their PE ratios. So there are a lot of investors who have made a lot of money very, very quickly in that, and a lot of investors are trying to follow on that. So right now, because of some of the and cryptos, I think we can't avoid it. You turn on the news, you read about it. I think those spaces, those two spaces, have really distracted people from investing into oil and natural gas, which is a traditional home for the risk capital.
And you said you see it coming around. Why are you convinced or confident that that's going to come around? Is it because of the nature of these new investment areas like cannabis and crypto, that they're quite sort of high growth, quick spike based on new regulation, legalization, etc.?
Flash in the pan. I think a lot of people will make a lot of money, a lot of people will lose a lot of money, and then everybody will the market will normalize. There'll still be a piece of the market, but we'll see the market normalize, and a lot of people will start drifting back towards the risk capital investment, especially when we see prices being a little more sustained, a little higher.
Okay. At this point, I'll open up to the audience, actually. Have we got any questions for our panelists up here? We have a microphone to take round. One area I wanted to touch on that we'd sort of discussed previously in our notes before this was sort of looking at unconventional exploration. and what's the sentiment towards that? We had a panel before this. I didn't catch all of it, based around unconventional, and we obviously look at the sort of shale gas revolution in the US and how that's been very successful in many ways and had its nuances as well. Is there a big bright future for unconventional exploration ahead globally?
I think you have Quadrilla speaking tomorrow, don't you?
Yes.
Yeah. So they'll be able to update us on the
UK.
staggering success in the UK.
Yeah.
There's been a lot said about that because it could be literally groundbreaking. It could be very good, but it could also be very, very bad in terms of results. We don't know whether it'll be commercially successful or not, but they have claimed to have had higher productivity than they're expecting. But I think Britain is the only country in Europe which either allows or has the potential for shale, because other countries have either banned it or they don't have the resources to do it. I mean, Poland ought to have had, we would have thought, a lot of shale success, but no, everyone there has failed. But there is coal bed methane, and that I think is often not overlooked because that coal bed methane was the cradle of the Australian LNG industry, which is and Poland, every country with coal beds ought to have plenty of coal bed methane in them, but those aren't really being developed, except for I think Poland has a couple of projects, but it's all very, very small scale.
And is that because of the prohibitive costs compared to conventional? What sort of
I don't
prohibiting this other than
think in the case
political
of
agenda?
Poland it's only about cost, because for them it's all about politics. They don't like buying Russian gas. It hurts them emotionally and financially. They'd rather have their own resources, but they haven't been able to bring them to market cheaply enough. And I guess they can't keep subsidising it. So yeah, I'm not sure what the reasons are. It must be harder than it looks.
Adam, are you seeing any sort of favour for any particular type of conventional versus unconventional in the deals you advise on, or what the investors are looking at in terms of your line of work?
I think there's a elephant in the room that none of us have touched on, which is the U.S., and that's really where all the deals have really been happening. That's where the pricing is good, and unlike Europe, there's a confluence of amazing factors. You've got strong royalties, you've got an entrepreneurial spirit, you've got the right structure put in place, but also you have wide open space, which is what Central Europe and the UK don't particularly have the same way, and the interest in developing the resources quite the same way. So we are seeing a lot of interest, but the interest primarily for that is in the U.S., and you will continue to see the U.S. Become much more of a global gas player.
And that's also partly due to their operating environment, you think, in terms of permitting and drilling rights, the speed with which you can monetize the molecules?
Exactly. I think you've got the world's biggest economy with the biggest per capita user of energy in the world. They are going to rush to, and a screaming desire for energy security. They've gone to wars all over the world for energy security. You're going to see their natural resources sector be developed as a high focus, both from the private sector and the public sector.
Okay.
And also, they have the geology as well. There's plenty of shale in Europe, but it's just far too fractured, I hear, for it to become commercially exploitable.
Shales ain't shales. There's a lot of places in the world where it will not work, and there are a few places where it does. And it's a combination of open space, it's a combination of the right geology, and having the regulatory environment in place. And you could look at somewhere like Australia, which has huge potential for unconventional, and yet if you're out in the middle of the great sandy desert trying to do an unconventional play, where's your water coming from? And then once you've cracked that little problem, where are you going to send your product to? So there's an awful lot of resource around the world that is available to unconventional type development, but there are not many places in the world where the combination comes together.
It's funny that the conversation came full circle back to gas is great, but it's an infrastructure play.
Yeah, and I think just on that point, certainly, stranded barrels or stranded gas. This is still you've got to find the stuff, and then you've got to be able to market it in a economic fashion. And this is nothing's changed in that respect. Maybe it's even more important, at this time. I'm just going to make one comment, just an obvious comment on exploration in the present climate. The plus side of that is, and certainly we're seeing it, cost of drilling, cost of equipment, cost of everything is substantially down from where it was a few years ago. So for multi-drilling type programs, you can put these together in a very competitive way at the moment, I would say. And that's a big plus for the industry over the next, couple of years.
I would say, despite your observations about infrastructure, there are ways of making it work. There's a company called Galileo, which I think is Argentinian, and they move their wells around from place to place, and they just suck the gas out and they send it into power on the spot. So that monetizes the gas immediately. And I think that's going to become more the way forward, because as the world becomes more and more fragmented and more and more marketplaces, then there's more and more role for little companies, little aggregators to step in, produce stuff. There's a company in Britain as well, I think it was specialising in coal mine methane, where you put a power plant on top of an old coal pit, and you extract the methane from that, and it turns otherwise methane leakage into electricity. So I think technology will eventually solve these problems, as long as gas is still needed by the time that day arrives.
Yeah, indeed. So no questions from the floor then? No? One down here. Yep, please.
How do you see the future of Holland as a gas producer?
It's not.
Okay, thank you. Because parts of their cities are sinking, according to the press.
Yeah, they've
together with global warming, they probably face hundreds of billions in cost to reinforce.
What they want to do is make everything biogas or green gas. So less and less. Groningen is going to be zero by, I think, 2030 at latest, but it's already on about, I think, going down from 23 to 12 in the coming few years, and then to zero, because of, as you say, there's been land or sort of tremors which have destroyed buildings. So politically and financially, they're going to move away from gas towards biogas, and they're looking at all kinds of ways of doing that through hydrogen as well. So it's a question of keeping. I think pipeline companies are very keen to have their assets extended or their life, not have them all closed down because there's no gas. So they're looking at ways. It's them rather than the gas producers who are looking at ways of providing the commodity to pump through the system. And biogas is going to be a rising proportion of the Dutch pipeline mix.
If I may follow up on Kazakhstan on the other side of basically Europe, how do you see their future with Russia, for political reasons, being, we have to buy, but we don't like it.
Well, Kazakhstan is a big exporter of gas, isn't it? It's
sure.
a big producer.
So you see a good future for them, or because they have, of course, a very big disadvantage logistically.
But they've got China next door to them as well, so they have big, and they've got the CAC pipeline going through, and they can pump more gas into China that way. But they've got vast amounts of gas. The Karachaganak plant is extremely successful, and condensates is what keeps it going, as with so many other projects like Qatar LNG, which we didn't mention either. Qatar LNG, that's another problem for the.
I mean, just on Kazakhstan, we've been operating there for 25 years. I think one of the biggest, the problem is their little brother to Russia. Obviously, the biggest problem with the Kazakh economy was when the Russian ruble collapsed, and then the currency suitably followed in Kazakhstan, which it always does about 6 months later. So that just means that then capital for reinvestment, it also hit the banks very badly. So for me, I'd say it's the bigger sort of macro picture which really affects the Kazakh oil and gas. As you say, they've got the market next to China. We export gas to China. There are good practical business relationships there. There's no problem with any of that, but it can't get away what ultimately happens next door with a bigger neighbor.
There you have it. Okay, but if there are no more questions, I'll just sort of quickly wrap up. I was going to ask you sort of how bullish everyone is on gas, but I'm pretty sure everyone's got a quietly confident stance on it. So perhaps just ask by your views on gas price. Is it where you think it should be, and what are your sort of near to mid-term outlook on gas price at the moment?
I think it's very much, despite what I said earlier about being about the link to Brent being broken.
Sure.
Nevertheless, there are plenty of examples in the world where it's still very explicitly tied to the crude price,
Yes.
or implicitly it is because simply you need energy and you can use gas or you can use distillates. So there's bound to be a certain amount of correlation anyway. But I think looking at Europe, we're now becoming more and more import dependent. So I think what we're going to be seeing is fairly low prices in the summer, but we could have very high prices in the winter, as we did, I think, in the last winter, because this winter, it was very long, very cold, and happened at the end when our storage was pretty much depleted. So we came very close to, we're over £1 a therm in some days, which is very, very expensive, and our big storage sites are being closed down or they're too old. So I think we're becoming more and more vulnerable to supply side shocks in the UK and Europe as a rule.
Interesting.
Because your only storage is in your pipeline.
Well, we still had.
Right.
Yeah.
I mean, there's a political issue.
Yeah.
I think gas pricing is becoming increasingly fragmented, and it's affected by local situations. Local situations it's about the infrastructure. So I think you need to have a quite local view on your gas market, which is kind of tricky if you're trying to lock in 25-year pricing. But there we go.
I completely agree with Al, and the question is, are gas prices right? The answer I would give you is where. In certain places, I think they're right. In certain places, I think they're incredibly high. And when you're paying people to take away your gas in Western Canada, I think they're definitely too low.
Indeed. Agreed.
Yeah, I'd agree with all the comments so far. And becoming more localized maybe as well.
Fantastic. Well, there you have it. We've covered a lot of ground in that time, and we're now a bit over, and it's keeping us from lunch. So I'd just like to say a round of applause for our panelists, please. And thank you very much.